Hi, this is Rick Savitsky from Chortek. In this video, we're going to walk through an example that demonstrates an impact of a very significant new addition in the One Big Beautiful Bill Act, a very tangible incentive for manufacturers to invest in either a new facility or to expand an existing facility used for production. And it's dramatic because instead of depreciating it over for tax purposes over 39 years, we're going to see we can take it immediately, immediate deduction off of taxable income. So the questions that stem from that are numerous. Okay, for any one scenario, what is the actual tax impact? But very importantly, when do we realize that tax benefit? Can we take it immediately? Do we have enough other income to offset? Or is it going to be something we're going to realize over time? And if we need to borrow money, over what period of time does it cash flow? That's what we're going to be using as our scenario. And we're going to work through that using a tool called Fathom that Chortek uses with our other manufacturing clients so that we can all be on the same page with assumptions and the backup behind those assumptions so that we can give solid advice and business owners can make strategic decisions. With that said, there's some provisions of this new act related to qualified production property that we're waiting for some details on, and those are important, but the main modeling we can absolutely do, and we encourage you to reach out for actual tax advice and business planning advice for your situation. So please do contact us. We'd love to talk to you. I have another video that's very similar to this with some of the assumptions. Small, medium manufacturer, S Corp. We're going to model taxes or cash that needs to come out so the shareholders can pay the tax. And in that other video, it's about capital equipment and using working capital to cover the cost of it and kind of showing how that plays out for the business. Similarly, we're using the same base scenarios here, but we've got, again, $4.6 million we're going to assume is going to be spent on an existing property to add additional space for capacity, and but we don't have that much cash. So we're going to model borrowing money, the 4.6, the full amount, over either 10 or 20 years. And we're going to see, well, how does that play out? And do we have the cash flow to cover it? And what's that divergence over those two amortization schedules? And then finally, we're doing this because we expect to have a substantial increase in revenue. That's why we're expanding, to have space for additional personnel, additional equipment, maybe space for additional material that we're going to have for some value-added holding and stocking, etc., for some of our customers on a special program. Main point is we're doing this because we think there's going to be, and we're planning on a very substantial, tangible increase in revenue. And then from that, from our baseline, calculated changes in our gross margin based on existing performance, as well as all the way down the line to net income based on this change. So that's going to generate more income, more taxable income. Is it enough to cover this massive write-off of a $4.6 million building expansion? That's what we're going to be working through together. One thing we got to quickly run through is the fact that we have to record that $4.6 million differently for different purposes. For book purposes, we're going to depreciate it over time. I'm assuming a 20-year life, and we're just going to straight line it over that period of time. Okay. For tax purposes, it's very black and white. Essentially, the amount, 4.6 million, needs to be depreciated and taken as a deduction, not all at once, but over 39 years, not 20, 39. There is an important distinction. Some of the costs could be into slightly different buckets with different shorter lives, faster depreciation, but generally, the main thing here is we're going to have a much longer runway until the new One Big Beautiful Bill Act. Okay, and that's again the dramatic part here. We're able to deduct that and write it off immediately. So what is the tax impact of a $4.6 million asset that we depreciate immediately? Well, on one hand, that's a relatively simple question. So I'm going to just show you here. We're going to take literally 4.6 million times our blended tax rate. There's the answer, 1.6 million. So why do we have a video to, that's relatively straightforward. Do we need a video really to calculate that? Well, the difference, as we're going to see here, is, well, when do we actually get the benefit of that 1.6 million? That's the part that's not the simple calculation. And that's why we're going to use this tool, Fathom, not just to do this one-time calculation, but every month on a recurring basis. We're going to have this model that we're building update as the business continues to perform. And we're going to roll this forward and use this baseline and to be able to model these assumptions and do more planning based on the complexity of a real business. So I'm going to start with the bottom line up front. I'm going to show you a few graphs, actually show you the calculations, and then we're going to look in the detail of the forecast itself. So the bottom line is I have in the forecast several permutations of these variables that we've talked about. Loan amortization, 10 versus 20 years, different types of depreciation. I'm not graphing all of them, I'm graphing a handful. And what we're showing here is the fact that the tax that's actually calculated is based on year by year, relatively straightforward to calculate, and I have a massive tax benefit when I'm showing the bonus depreciation, not just of the building, but actually of the other equipment from the other video. And so we're getting a massive benefit, and then year after year after year thereat, we've got calculated tax each year. Okay? And in green is my baseline where I'm not assuming any building expansion. So what's important here is that, yes, there's tax that's calculated. The question is, well, do we need to distribute the money for that, or can we actually get a refund? And the short answer is no. We can't get a refund. We've turned the scenario here as showing that nope, we can't necessarily just get the money from the IRS, and instead we're going to offset that tax benefit year after year after year against other taxable income. And that's the big divergence here in these two graphs. The top is showing no expansion or our book depreciation, but in purple and in blue we're showing what happens if we in fact have this benefit, but we don't have enough other income to offset it. It's showing us over time when we're going to have that intersect and get back into needing to have distributions to cover total taxable income. That's the big thing that we're solving for here. And we're seeing that we're, of course, below this 0 point in these two scenarios, and the 10 and the 20 years start to diverge based on the amortization and the tax impact of that. So that's what this tool is allowing us to do. We can, of course, also just graph cash, show this big pull down of cash for the equipment in the other video, and now we're seeing cash grow over time. Again, green, no expansion for the building itself, and then blue is that book depreciation over time, but the big difference here is this tax difference between paying it over 10 years or 20-year loan amortization and how much cash is projected to be remaining in the company. Now, in reality, most businesses aren't going to actually keep that much cash in the business, but this is helping to show that dramatic difference and the time that it takes of when we're going to have the impact on cash. Generally, that money is going to get reinvested for other equipment. But again, being able to calculate the tax impact of that other capital expenditure is really the key of what we're doing with this tool. So I'm going to share my screen, and we're going to walk through some of the building blocks in the forecast. And I'm going to make it larger here to see. And first off, I'm going to indicate that we're collapsing a lot of the detail on purpose to make it a little bit easier to follow. We're collapsing all of the detailed P&L accounts, profit and loss, that make up our forecast, and we can have layer upon layer. And I'm purposely kind of showing it, collapsing it so that we're going to focus on a few key numbers: the depreciation and the tax calculation, net income, and then very importantly down below, the amount of cash on hand. And so on our baseline, without the business expansion, we're expecting a cash balance at the end of the 5 years of 1.2 million. What I'm going to do now is click and select a scenario. I'm going to pick the combined equipment and building expansion, assuming book purposes, and a few key numbers in here changed. Depreciation changed. I now have debt service over the 20-year assumed life, and income tax is changing as well for book purposes. And our 1.2 goes up to 2.2 million in cash. Turn that off and go back, turn it back on. That's just a really, really simple way of seeing. Here's a scenario with just the expansion without the equipment, and I can pick and choose essentially which building blocks I'm looking at in my scenario. Now, those building blocks, we're able to do several important things. We can change the timing assumption of when they occur. I'm going to keep them the same for right now. And for our building expansion, I'm showing here that we kind of have twin scenarios. The building itself and the depreciation of it, and then also the loan and its amortization. I could adjust the timing of those very easily if I needed to. If I click into it, I'm not seeing the entire P&L in the balance sheet. I'm seeing only which accounts are impacted. Namely, we're going to increase, we have an asset for the building, 4.6 million. We're depreciating it straight line over time. And I have a few other miscellaneous non-capitalized expenses. So there's a little bit more, going on here, but the main idea is, okay, for this scenario, I can now toggle this actual transaction, which possible scenarios, those green buttons in the upper right corner, to which ones does this apply? And that's really important here because we can essentially have, again, these building blocks of scenarios that we then combine into a view of the possible future and combine that, contrast that with different building block assumptions. So just to continue, I'm going to look at the parallel assumption here of the loan. So we're going to not take the 4.6 out of total cash. We're going to borrow the money to put it into cash, and we're going to build a new loan in order to do that. And then we're going to amortize that. We have assumptions for the interest rate and, again, the tax impact on it as well. So very easy, of course, in different versions to say, well, what if my interest rates are going to be higher over certain future years, or they're going to drop? Okay, and then we can model and, again, see that difference. Main idea here is, all right, we're building some possibilities, and I'm not going to click through it right now, but if I look at that same scenario for the building with a tax traditional write-off over 39 years, I'm changing that depreciation amount. And then, of course, the tax calculates differently based on that. And in contrast, we'll look at it real quickly here. If I look at my scenario with the combined bonus depreciation, I click in and look at the scenario here, I have massive depreciation immediately and then no depreciation in future years. That is the definition of taking the depreciation all at once, and again, this massive tax impact of it. But again, part of what we're able to use in this Fathom tool is affect the timing of when does that tax actually get paid or need to get distributed out to the shareholders. And that's the big difference here that we're taking advantage of. So I'm going to make my screen larger again and emphasize this idea here of being able to go in, build different scenarios, and pick and choose which items of my building blocks I'm including in that particular scenario. So again, very easy here. You can kind of see where I could say, all right, well, now I want a scenario with 10-year scenario instead of the 20, and then be able to model that. What's really helpful in order to see the impact is to build reports that are going to be shareable with everybody that needs to weigh in on the decision, build and have documentation of the assumptions, and then again, these graphs can help combine and contrast the different scenarios. So as I shared earlier, we have the distinction here. We can see year by year the tax calculation of my scenarios. I'm hiding some of the other scenarios to make it a little bit easier to look at, but I could easily click on, click off. So we've got our tax liability, And again, we're showing this distinction here between how much cash over these years needs to be distributed out to cover tax versus how much is being shielded year by year because of this tax benefit, which we're chipping away at. And based on the slope of the graph, it's looking like in year 6 and 7 we're going to be back up to parity. And again, looking at cash, I can look at it on a quarterly basis, look at it on an annual basis, and we're going out as far as 5 years. Then finally here, looking at the debt and the distinction between paying and the value of that debt over the 10 years versus the 20 years. So the Fathom tool is allowing us to collaborate. It's allowing everybody, including potentially the lenders, when the time is right, to share this projection as well. And further down a report, I can have all the detail behind my assumptions. 3-way forecast, balance sheet, cash flow statement, income statement, and we can get all the way down into the detail accounts as well. So we're looking here at a summary, and this allows us to have conviction and debate if we want to debate some of the variables and assumptions, but then document those and then ultimately lead to reaching a conclusion. And that's what we're able to do using Fathom, collaborating with clients. This is a complex topic. There's a lot to talk about, especially with tax. So it ultimately gets down to what else is going on, both with the business, but also the shareholders and their tax situations. And there's some really healthy conversations that can happen in tax planning with this new provision. Which entity actually does the acquiring is another complex matter. We talked about federal so far. I've talked about this is all federal related in the One Big Beautiful Bill Act. That may not in any way, shape, or form be modeled, or the states may not be piggybacking on that change. In fact, they probably aren't. So that's really important to also factor in. And I mentioned that term cost segregation study. It may minimize with this equipment, the building expansion, the need for a cost segregation study, but again, tax by state is also different, and so it's something to be considering. The timing of when all this happens and when you would consider pulling the trigger, so to speak, of proceeding with an expansion, and the time realities that there are some limits right now is also very important. And I could keep on talking. There's a lot of different things to consider, and so we'd love to talk to you. Please do reach out. This is part of, we really enjoy working with our manufacturing clients and helping them be successful with good, solid planning. So if this video is helpful, please give it a like. Please share it with someone that you think would benefit. Please give us a ring. We'd like to talk to you. Thanks a lot. Bye-bye.